financial advisors controlling 10 to 30 trillion dollars of wealth. You're talking about institutions having the same exposure. You're talking about 401k platforms that are another $8 trillion. If all of those people start allocating 1 to 5% to crypto, you're talking about hundreds of billions and indeed trillions of dollars of inflows into this asset class. And I'll leave it to your imagination about what that means in terms of price, right? But look, if we think crypto is the foundation of a new financial rail, it has to interact with most of the financial market. That's what you're seeing start to happen now, but it's a multi-year story. With the down payment we've seen in 2024, it's just that. It's just a down payment. It's just a holding mark. You're going to see that amplified in 25, in 26, in 27.
Matt Hougan highlights the stark contrast between crypto's current market cap of approximately $3 to $4 trillion and its potential to scale toward $20 trillion or more, echoing gold's historical growth. The driving factor? The immense pool of institutional wealth, ranging from financial advisors managing $10 to $30 trillion to 401k platforms worth $8 trillion, currently underexposed to crypto. Even a modest 1 to 5% allocation from these sources could result in trillions of dollars flowing into the crypto market. Hougan shares valuable lessons. He cautions against letting fear of volatility cloud long-term perspectives, noting that many investors missed out on massive gains by exiting too early. This cyclical nature, coupled with exponential growth, creates opportunities for those who stay the course. Hougan predicts that 2024 is merely a down payment on crypto's future trajectory. The coming years, particularly 2025 to 2027, will likely see amplified growth as institutional participation deepens and regulatory clarity emerges.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
We talk about gold today as this well-established institutional asset that struts around Wall Street with a three-piece suit on and a top hat. But the reality is, back before there was an ETF, that wasn't true. It was mostly held by retail investors. People were called gold bugs and they were diminished. People didn't think of it in an institutional setting. And the reason is pretty obvious, and it'll sound familiar. If you're a large institution that's used to buying stocks and bonds, it's a whole different thing to hold physical gold bars and worry about custody. It's a whole different market to access. You don't trade them on the New York Stock Exchange. You don't custody them in the same way. They literally don't show up in your portfolio reporting software, so you can't figure out what your returns are. Once the ETFs came into the market, there was an explosion of institutional interest in gold as a portfolio asset. We saw $3 billion in inflows in year one, 5 billion, 7 billion, 10 billion, 18 billion. Today, maybe $100 billion. And that has an echo effect in how the institutions think about gold. It's made it. Again, it's accepted. Okay, the same thing is happening in crypto. Before the ETFs launched, yes, it was possible for people to invest in crypto, for traditional investors to invest in crypto, but by and large, they didn't, because it was too hard, because they didn't trade Bitcoin and Ethereum and XRP in the same way they traded Apple and Nvidia and Microsoft. And what we've seen since the ETF launch is an exact repeat, except magnified about 10 times, right? We've seen $30 billion flow into these Bitcoin ETFs. They've been the most successful ETF launches of all time. We've seen pension plans allocate. We've seen university endowments allocate. We've seen hedge funds allocate. I'm telling you, Brad, we've seen this story before and we know how it ends. I'll end with one statistic. When gold ETFs launched, they were about a $2 trillion asset class. Today, they're $20 trillion. When Bitcoin ETFs launched, again, about a $1.5 trillion asset class, we're at 3 or 4 trillion. We're on our way to 20 and 50 and beyond. So again, we have seen this story before. This is how institutional asset classes are born, and you're witnessing it before your eyes, and you still have a moment where you can front run the institutions. This is where most of the money is, right? The incredible thing about crypto is 95% of all crypto assets that will ever exist are probably already owned by someone, and 95% of the money has no exposure to it. Those are going to have to cross at some point. I mean, these are very big markets. You're talking about financial advisors controlling 10 to 30 trillion dollars of wealth. You're talking about institutions having the same exposure. You're talking about 401k platforms that are another $8 trillion. If all of those people start allocating 1 to 5% to crypto, you're talking about hundreds of billions and indeed trillions of dollars of inflows into this asset class. And I'll leave it to your imagination about what that means in terms of price, right? But look, if we think crypto is the foundation of a new financial rail, it has to interact with most of the financial market. That's what you're seeing start to happen now, but it's a multi-year story. With the down payment we've seen in 2024 is just that. It's just a down payment. It's just a holding mark. You're going to see that amplified in 25, in 26, in 27. You know, we have restrictions around what we can say. So I can confirm that we have an XRP filing. I can confirm that Bitwise doesn't file products for fun. We only file products when we think there's a reasonable chance of them launching because it's expensive to do. And so we're optimistic on this space. If you step back and look at this at 30,000 feet, I think you'll see the big picture. A lot of people get lost in the weeds of this, but here's the big picture. We've gone from no ETFs to ETFs on Bitcoin and Ethereum. XRP is obviously the third largest crypto asset, so it's the obvious next one to focus on. We're moving from an SEC that is hostile to crypto to one that understands what crypto is about and is pro-innovation. When you put those two things together, I obviously can't guarantee anything about our application or anyone's application, but I can say that the trends point towards more ETFs in the future. And I will note, we already have XRP ETFs in Europe, and they're very successful, right? And there is significant demand. So I'm confident long-term, without speaking to our application, that we will get XRP ETFs here in the US. And I'm also confident that there'll be a big market for them. You can think of ETFs as opening up to the market to people who will consider XRP by a factor of like 10 or 20. And just like not every crypto investor ends up investing in XRP, many do, but not everyone. Not all of these investors will end up focusing on it either. But when you widen the aperture and when you start telling the story of what's going on in a blockchain like XRP and the related ecosystem, you will find people who want to gain exposure to it, who are excited about the idea of what could happen when the regulatory pressure is off of this public blockchain and we get to see what it does in the wild and see what that business demand is. So that's what's going to happen if we do get successfully to be able to launch these ETFs.
Hougan paints a vivid picture of the crypto ecosystem's evolution. He stresses that the journey from niche investment to institutional mainstay mirrors the paths of other asset classes like gold. ETF are central to this transformation, bridging the gap between traditional finance and blockchain innovation. Bitwise, founded in 2017, has been at the forefront of this shift. By creating products like the first crypto index fund and working on ETF, the firm aims to simplify crypto investing for institutions and individuals alike. Hougan highlights the broader societal impact of crypto, from financial inclusion to enabling a more efficient digital economy.
Bitwise started in 2017, so we've seen some ups and some downs and some ups again in this crypto market. You know, today managing well north of $10 billion in client assets. We got started because we thought it was too hard for most investors to access crypto, right? It's difficult to build a portfolio. It's difficult to have names that you trust. We wanted to take crypto and put it in traditional financial vehicles that have worked for years. Not for everybody, but for a certain set of people that makes it easier to access. We started with the first crypto index fund, and we've been working on crypto ETFs and ETPs ever since. It's been a long journey, but we've gotten to the point where we started really rolling them out, and they've found a major audience.
On a risk-adjusted return, they're actually better. They massively outperform. As I said, the NASDAQ is down 99.97%. If you take it even from 2017, the NASDAQ's down 50%. So it's an extraordinary outperformance. So it's a bit of a superpower, but you take some volatility to go with it. But really, all this is a technology that has a built-in incentive system in it. So it's behavioral economics meets the infrastructure layer of the internet. So if you think about, and it also changes lives, and it brings people into the financial system and gives people opportunities. There's a very larger reason why this matters, but it also matters just for the internet. In a digital age, we need to be able to transfer, store, and record value. Mm-hmm. And value could be everything from our ID to a contract to a store of value like Bitcoin. So it's a very broad concept that's very necessary for the internet as we move forwards into a more digital age, particularly with AI coming at us fast. But it's also the financial inclusion side. It's also the fact that people can access dollars via stable coins anywhere in the world. I mean, these things are revolutionary. Mm-hmm. And the adoption of this technology is twice the speed of the internet. And it has been. I rebased them both from 5 million wallets versus 5 million IP addresses. And look, wallets is not a perfect thing, but nor is IP addresses. We've all got multiple IP addresses and multiple wallets. Okay, so it's broadly similar. But the growth has been twice the speed of this technology. And so it goes up twice as much as the NASDAQ. I mean, it's pretty simple, really. Mm-hmm. Ask most people who were in last cycle, and that was their first cycle, they have tremendous PTSD. Because they looked back on the 2017 cycle, and 2017, the market peaked in March before tax season. It then corrected, so it peaked at 2000. It then kind of corrected, and then it went up. It went up 10x in 4 months.
You had the China correction in between as well.
And so last time, I also thought, okay, we saw the tax season correction, then the rally back up. It was a big correction, down 50. Mm-hmm. Then it shot up, and it's like, okay, it's going to be 2017 again. And it wasn't, because the central banks would start to withdraw liquidity, and the business cycle had been brought forward by the massive liquidity was starting to come away, and that was the end of that. So this time, when you go on X and you see people, they are so PTSD'd by that I think that many will sell tax season March and then get trapped out. Mm-hmm. And then they'll expect an early peak, and maybe it does peak. From my liquidity work, it still suggests that it peaks at the end of the year, towards the end of the year. But it depends what happens to liquidity. But if that is the case, I just think the risks are here, and then the risk is 2026 is the people who then sold out, maybe they screwed it up, and maybe they got out like I did in 2017 way too early. You then try and buy it back, and you end up buying back at much higher prices, which is what happened to me. I ended up buying back in COVID in that crash, and I got in at 6,500, but I'd sold out at 2,000. Mm-hmm. And I'd done the job. I sold out into strength and bought into weakness. Difference was, in a secular exponential uptrend, the difference between that peak and that trough was like this.
Matt Hougan's insights reveal a powerful narrative. The rise of crypto ETF is not just a financial trend, but a paradigm shift. As we witness the institutionalization of digital assets, the parallels with gold's journey offer a roadmap for what's to come. For investors, this is a rare moment to position themselves ahead of massive inflows and exponential growth. Crypto is no longer a fringe technology. It's becoming the backbone of a digital financial system. Whether you're an experienced investor or just starting your journey, understanding these dynamics is key to navigating the future of finance.
Please like and subscribe my channel.